Joining us right now, Principal Global Investors Chief Global Economist, Bob Baur. Bob, good to see you. Thanks so much for joining us.
Good morning, Maria.
How do you feel about markets right here?
Well, the volatility that we've seen is, I think, indicative of a broader picture that we see. And I think maybe the best way to explain what's going on today is to understand there's kind of a dichotomy or divergence between the real economy and financial markets. The United States is doing just great. Consumer spending's fine, robust capital spending. We also have a red-hot labor market. But on the other hand, financial markets are being impacted by this gradual withdrawal of the trillions of dollars of liquidity that was provided by central banks and by China as a response to the global financial crisis. So we kind of call it a short way of thinking about it is that Main Street may be doing better than Wall Street.
What do you think that's going to do with our GDP next year? I mean, some economists are calling for a slowing. We may not hit a 4% number. We may have mid-threes, maybe even low threes. What is your assessment? I know the first quarter is weak, but on an overall basis, are we going to lose the effects of the tax cut?
Well, no question. I think there's going to be a little bit of deceleration next year, but still 3% growth is well above trend. We would guess trend growth is probably in the 2 to 2.5% range, maybe 2 3/4. So even 3 to 3.25 is still above trend. And we'd think if 3% growth all of next year, that'd be just great.
Is the U.S. market still a safe haven? I mean, you look at what's going on in China. Way before the tariffs started, you had problems with the Chinese economy. You have a potential Italian debt crisis going to happen sometime later this fall. The EU is in trouble. You look at emerging markets, they're in trouble. It seems to me that the U.S. stock market is the only place to be for safe havens and for some type of return. Is that going to continue?
Well, I don't know. The U.S. has clearly been the outperformer, really, ever since the low in March of 2009. And I think it will continue to be fine through the end of the year. I think we'll continue to outperform. But next year, I just worry about financial markets in general because the Fed is well along in its path to withdrawing liquidity. The ECB is going to start doing it next year. The Bank of Japan won't be that far beyond or behind. We've seen other central banks throughout Europe raise interest rates. And I think this gradual squeeze of liquidity is just going to make it very difficult to find good financial returns next year.
Which assets are most overinflated, though, still, in your opinion?
Well,
based on that central bank stimulus.
Well, clearly, from a valuation standpoint, the U.S. stock market is still highly valued. If you're looking for a place to hide, frankly, I kind of like commercial real estate because that kind of bridges the dichotomy between the real economy and financial markets. Property prices are clearly impacted by the rise in interest rates. On the other hand, if the economy is really good and you get a little bit of inflation, you're going to see rents rise. So you could get some returns there.
Yeah, there's rent escalators, and commercial real estate is actually one of the best inflation hedges, right? Because not only the replacement costs of the assets, but also the rent escalators that you're talking about. And we've saw that REITs have been actually pretty resilient this last few months.
You don't think that the real estate market moves in tandem with the stock market?
Well, it does somewhat through the impact of interest rates. But if you really believe, as we do, that there is this dichotomy or divergence between the real economy and financial markets, then because real estate is impacted also directly by the real economy, that might be a place to hide. Another place to kind of think about is just commodity markets in general. Outside of oil, commodities have really been in a downtrend now for some time. And it's possible that if we're seeing a mild, modest resurgence of inflation, that a bottom in commodity prices might also be another place to hide.
Well, that's the point that the president has been making, that we really haven't seen much inflation. He's taking on the Federal Reserve again, as you know. This time he mentioned it in an interview with Trish Regan yesterday.
My biggest threat is the Fed, because the Fed is raising rates too fast, and it's independent, so I don't speak to him, but I'm not happy with what he's doing because it's going too fast, because you looked at the last inflation numbers, they're very low.
But you put him there. I mean,
I did.
You think about Janet Yellen, and she was so dovish.
Can I be honest?
Yeah.
I'm not blaming anybody. I put him there. And maybe it's right, maybe it's wrong, but I put him there. What if he gets it wrong? I put a couple of other people there that I'm not so happy with, too. But for the most part, I'm very happy with people.
Your reaction, Bob?
Well, I think I think inflation is going to continue very mild. But, you know, I'm not sure all of the dot plot is actually going to happen. I think the economy is doing well. I think the Federal Reserve is clearly going to raise rates again in December. They may raise rates again in March. But frankly, then you get the top of the range up to 2 3/4, which is right in the middle of where people think the neutral Fed funds rate is. So I think the Fed could easily pause after a hike in March just to see how the economy adjusts.
It seems like one of these
That makes
dichotomies here is the underlying market right now is trading on the economic fundamentals, which is what you want it to trade on. Earnings are good. You have great economic numbers, but you have a lot of geopolitical uncertainty right now. Every bull market ends. There's no doubt about that. What is your biggest worry right now that could end this bull market?
Well, I think
is it rates?
That's one thing. If we get another big surge in rates that happens really fast, I think that would be a negative for the stock market. But I think the other thing is if there's some problems that end up from what's happened in Turkey and Saudi Arabia, and we get a spike in oil prices, you know, that's always been negative for the U.S. economy. In fact, if you look back to recessions in the past, I think almost every recession since the 60s has been there's been a harbinger of that in fast rising oil prices.
Yeah, that's a good point. I was thinking about that earlier, actually. What happens if oil starts spiraling up?
$100 oil would not be good.
Not good. Bob, it's good to see you.
Thank you
so
very much.
Bob Baur joining us there.